I want to update you guys with what's going on with mortgage rates because we are seeing some pretty drastic moves that are going to affect you moving forward through the end of this year and into 2024. And this is actually good news because interest rates are now back under 7% after spending much of the last couple of months in the high 7s, 8% range, depending on where you went and got a mortgage. So, this is really good news because, guys, I got to tell you, for a while, things were just not looking good. And as the president of a mortgage company, I can tell you that every single day in October and even into November, interest rates just only seem to get worse daily. So I want to talk to you guys about in this video why this is, why rates are what they are now, what we are forecasting through 2024, and how this is going to affect you guys if you are thinking about getting some sort of mortgage financing. So that means, either you're buying a house or you're refinancing. Now, first and foremost, I wanna talk a little bit about why the rates have been going up, right? And also why they are the way they are right now. In short, to make it really simple to understand, is rates are high because of inflation, okay? And because of the Federal Reserve's policies to combat inflation. So interest rates, to make it very simple to understand, they're basically based on different bonds in the stock markets. In the mortgage industry, we look very closely at the 10-year Treasury bond. Now, bonds are considered, pretty safe investments. They are a type of fixed income investment. So the problem is that when inflation is high, the demand for the bonds just goes down. So that pushes up the yields on the bonds. So in other words, we want inflation to be low because low inflation means that interest rates tend to go down, okay? That's obviously not happening right now. You can see it from the cost of, houses to cars to, even your groceries, right? So the thing is everything is sort of correlated. So when you are seeing that interest rates are higher, obviously that affects things like mortgages, credit cards, auto loans, any other consumer loan that you can think of. So we obviously want these the yields to go down on the bonds, the prices of the bonds to go up, because there's sort of that that inverse relationship between both. Now, lately, economical data has come out recently that is pointing to weaker economic growth. And now the markets are predicting, or at least they're hopeful, that inflation is receding. So all of these policies that the Fed has been implementing, which basically what they have done is let's just increase interest rates in order to slow down inflation, sort of seem like they are working, okay? And it's going to take a little bit longer for them to take into effect. But for example, the Consumer Price Index, or the CPI report, which was released about 3 weeks ago, showed that inflation was flat in October. Now, core CPI is the Fed's favorite inflation measure, and it rose at the slowest pace since 2021. For example, shelter increased by just 0.3% month over month, but still lower from September. Now, things like new and used car prices, airline fares, household furnishings, all have dropped from the previous month. Now, another thing that the Fed is taking a very close look into is the labor market. So obviously after 2020, more and more people are starting to come back into the workforce, obviously because of the pandemic. I mean, there was even a period of time where, it was sort of, people were just incentivized to honestly not working, right? I mean, all the stimulus and all those things made it for people to just stay home. But, with things costing a lot more, they have been coming back into the labor market in the drones, which is not good for inflation, because the more people that are in the labor market, that means that there is going to be more money, right, flowing through the economy. People get to spend more money when they have jobs, right? But so in a way, the Fed wants sort of a bad labor market, right? They want more layoffs. They want more unemployment. They won't say that publicly, right? Because it just doesn't sound good, but it is what it is. When people are laid off, they're not going to spend, a lot of money, right? So less money in the economy. So anyways, with the labor market, it's also slowing down. Last month, non-farm payrolls show that October payrolls increased by just 150,000 new jobs, while labor costs have been increasing, but at a much slower pace over the past year. So, with those two things, with CPI and the labor market, this has been sort of like the most closely watched things that investors are looking at right now. And it seems like the Fed might actually be getting somewhere with taming inflation, getting it down to that 2%, 3% target. Now, I personally feel like we may get there. It just won't be as quickly as what some people think and what some people, hope for. Now, Jay Powell has maintained, even though, things are looking the way they are now, this data is coming out that, it's looking good for rates, for inflation, etc. Jay Powell has said that it's still too soon to think about cutting interest rates, and possibly more rate hikes might be needed. Now, this is something that I have told people, that we are sort of going to go back into, maybe rates are going to come down for a couple of weeks, then they're going to go up. Everything's sort of just based on what these readings are going to be coming out, right, every month. So even though we are seeing these rates, decreasing, let's not be extremely hopeful that they are just going to go down, basically every single month. Okay, so we might go up again. That's to be expected. So all in all, investors are actually betting that the Fed is not going to be raising interest rates at the December 12th through the 13th meeting. That's, kind of expected on Wall Street, that's not going to happen. So, things are going to be reassessed next year. Absolutely. All right. So let's kind of talk a little bit about where rates are going to be heading into 2024 and beyond. So, one really good, article is that the Mortgage Bankers Association has a latest forecast in November. They expect rates to drop significantly in the first quarter of 2024 to an average of 7.1%, which is kind of where we are now, right? We just dipped a little bit under 7%. Obviously, if you were to go and get a mortgage today, you might not get that 7% interest rate, regardless of whether you are putting a pretty big amount of money down, you have great credit scores, etc. At the end of the day, there are margins built into interest rates. But on average, this is kind of what's going on, right? Now, after the first quarter of 2024, the Mortgage Bankers Association is forecasting that there will be a sharp drop of interest rates moving forward through 2024. They expect them to hover around 6%. That is a 1% decrease from what's going on now, right, from 7%. And that will be huge for everybody, obviously home buyers, homeowners included, especially, the ones who bought a home in the past few months with the higher interest rates. Because what's going to happen, guys, and this is something that I tell people, is when, obviously the mortgage rates are high now, the prices of homes are high. The thing is when rates go down, home prices are not going to go down, because what's going to happen is that there's going to be more people looking to buy a house with lower interest rates, right? So this is the reason why real estate prices are expected to hold. So that's, this is kind of oncoming, okay? So the homeowners that are getting in now, or that got in sometime, this year with the higher interest rates, their home prices are going to stay. They might even go up, and they're going to be able to take advantage of refinancing, okay? Now, for, those, who are sort of in the sidelines of looking to buy a home, right? This is actually also good news for you, because the more that interest rates continue to drop, more existing homeowners who are locked into those historic interest rates of the pandemic, right? So those people that have a 2%, 3%, 4% mortgage, now they will be willing to give up those interest rates, right? Meaning that they are more willing to sell, to trade up, trade down their existing homes, right? So, we come across a lot of those people who, obviously they want to sell, they don't want to stay in their homes, but I mean, it is pretty difficult to go from a 3% mortgage to a 7% mortgage, right? A lot easier to go from 3% to 5%. So 2025, however, seems like it could be the year where we are going to see rates to start stabilizing into what I personally believe is, normal rates. According to the Mortgage Bankers Association, and actually Fannie Mae as well, 5% interest rates should be the average in 2025. And then who knows what's going to happen in the market then. One of the things that I'm always looking at is obviously the elections are coming, right? And that's going to be extremely significant because I don't believe that Democrats want to come into an election year with interest rates being so high. Obviously, the last 3 years have been pretty brutal in the economy. Yeah, you know, the stock market is doing great. Rich people, right, the wealthy have been doing really good. It's just sort of everybody else who have been sort of, you know, left behind, and everybody else makes up most of the economy. So anyways, guys, that, you know, hopefully this update is able to help you understand what's going on, what might happen, how this is going to affect you if you are, you know, thinking about buying a house in the future, whatever the case might be, you know, sell a house, etc. Okay. Hopefully this is really helpful. Thank you so much for watching this video, and I appreciate you guys if you give it a thumbs up, and I will see you very soon. Have a wonderful day.